Welcome back to Module 3, the model. Today we're going to discuss the different steps to building an algorithm. Then we're going to go into how to use the research toolbox to do research, followed by different methods of back testing. And then finally we're going to look at an algorithm I developed using multi-charts and learn the steps that you take to do that, as well as learning what the output is of that and understanding what all that means. So, the steps to model development. Referring back to the data slide of our last module, our first step is to select a market based on that criteria. So once we have that in mind, the next step is state the type of model. In this case, the model is mean reversion, suggesting that the price in the future will revert back to an average in some time. Another common model I've used in the past and a lot of other companies use is what's known as pairs trading, which trades two different securities, long in one and short in the other, and greatly reduces the risk by trading these two different securities. Another feature of pairs trading is the securities must be highly correlated, meaning they move together quite often. Most often it's 0.75 or greater. Step 3, research using the research toolbox. Use of technical indicators to select patterns and generate matrix elements. That's all done within our research toolbox, and we'll go through exactly how to do that, and hopefully you won't get overwhelmed by that. Step 4 is selecting the sampling frame. When do you want to test the model? When do you want it to be active? This includes certain times of the day, like normal trading hours, length of time. It's always nice to include periods of economic crisis to see how the strategy reacts. You'll see in the strategy that I develop, I run it all the way back until 2006, so that way I get the recession in there so I can understand how the strategy will react when the market does very poorly. And finally, number 5, I guess not finally, but next, once a pattern has been identified, you need to generate a hypothesis based on your research. So once we've done that, we can actually develop and modify the model logic. So this goes into developing your pseudocode and then finally going in and writing up the actual logic within your program. Next, channels to test your models. Well, we went over a little bit about SPSS earlier, but once you have a model in mind, you can use Excel if it's very basic. A lot of times when you're using Excel, you need to go into the Visual Basic part of Excel, which allows you to write code that will read off of data within your spreadsheet and print out certain numbers that allow you to do some preliminary back testing of your model. This is not something that I recommend. I had to do this, and it can become a pain, and it's a lot of syntax that you'll learn. I would suggest either using multi-charts for the time being or transitioning over to the strategy toolbox. Getting back to SPSS, SPSS is good for generating the mathematical models. When it comes to actually testing the strategy itself, SPSS is not going to be able to do that for you. All it's going to do is generate your multivariate regression models, as well as your logit regression, and maybe a hazard model as well, or any math function that you'd like to do is mainly focused in SPSS. And finally, multi-charts. This is a great tool, similar to what the research toolbox, the strategy toolbox do right now, except that you have to write it all out in code. So we'll go through an example of multi-charts with one of my models towards the end of the module here. So the algorithm that I developed, I named Stack Technical, and these are some of the steps that I took to get there. So now that we understand, we went through the steps previously, I chose the market, the S&P 500 E-mini. The reason why is it's extremely liquid and it's lower cost compared to other futures. Every point on the S&P 500 E-mini is $50 compared to, some others that are very expensive that, a little bit of loss can really hurt your portfolio. This model type is mean reversion, and it uses a series of technical indicators stacked together that creates a signal. The sampling frame we selected ranged from 2006, like I said before, up until September of 2013. And we chose to go back to 2006 to incorporate the recession and see how the model reacts. This will provide us with a lot of information that allows us to put checks in to eliminate poorly executed trades. And finally, we chose to place trades only between the time period of 7:30 a.m. through 2:30 p.m. and then we said all positions must be liquidated at 3 o'clock in the afternoon. That this is just for risk control, so that way nothing goes wild overnight. So here is a slide. It says Stack Technical Model Steps. This is using the Research Toolbox. This is a snapshot of what it'll look like. So obviously the first step to understanding the Research Toolbox is going through it. So number one, we have loading market data through this file. We can graphically display our data. We can search for features and matrix elements here in the palette by just typing in here. We can add these features either to our chart or to our collection down here. We can see we have different ones in here. We can display them numerically using the matrix. And then finally, we can run the pattern factory either based on a predefined pattern or one that the user defines themselves. Welcome back. This tutorial here is going to give you a brief overview of the Research Toolbox here at Blackthorn and some of its capabilities. So the first step to actually doing research is understanding how to use this. Right now it may not look like anything overly sophisticated, but once we dive into it and learn how it's used and what it can all do, it's actually a very powerful tool that you'll be using during your time here at Blackthorn. So we had a previous slide that kind of went over some of the major features of the Research Toolbox. And I just want to walk through that and actually show you hands-on how it's used and how it functions. So step number one is once we've selected a market, we have to load that data into the Research Toolbox here. Well, in order to do so, we go up here to the file to load a market. We click on the file and we can see here load market data. Well, we can load it in from a file. So if we have an Excel file or a CSV file saved, we can load that in. We can load it from web service, which connects to say Yahoo Finance, and we can load in end of day data from that. Blackthorn Warehouse, which is what you'll be using for the most part, which connects right to our warehouse here and can pull anywhere from 1 minute data all the way to end of day data, on pretty much any security that you can think of. And what we have a local database is it stores information that you've already loaded within the build, so that way you don't have to spend the time loading up the new data from the warehouse. It's just already stored there. It'll load up a lot faster compared to actually loading it in from the warehouse. So for the most part, you'll be loading from the Blackthorn warehouse. So let's click that, and we'll go next, and it'll load the symbols. Okay, so now we come to this screen here, and we can type in any symbol we want. So if we want to look at Apple, we should read Apple. Google. In our case, we're going to be looking at the S&P 500 E-mini, which symbol is ES. So we can simply click that. And now you can see we have 1 minute, 5 minute, 30 minute, 60 minute, and end of day. So we want 5 minutes, so we'll add that. And then in order for us to actually retrieve the data, we have to click Finish. This does take some time, so to save a couple minutes, I've already preloaded the data up here under the Markets tab. So I'm just going to click Cancel here. In your time using the Research Toolbox, click Finish, then it'll load it, and you'll get this market up here. So now you can see we have the S&P 500 E-mini market loaded. It's under our Markets tab, and it's ready to go. So what do we do with it next? Well, let's take a look at it in price bar format. So we'll just drag this 5 minute. So we'll click and drag it onto the charts here. We can see we have charts. Add a new chart, and let's look at candlesticks. So now you can see in the background the S&P 500 E-mini, and we can scroll through and see all this price data, 5 minute price data. We can also zoom in and zoom out very easily here. What we can also do is we can take it, add a new chart, and we can look at the volume. So now we can see we have volume for the S&P 500 E-mini, and we have price bar data for every 5 minutes. But a lot of times you want to look at different technical indicators as well. We have what's called a palette here that has many different functions that we can display. So let's say we want to look at the relative strength index. We type in RSI, and we can simply click and drag, and we can add a new chart. So here we need to add a new collection. Okay, and what that'll do is that'll take us down here to our collection bar. And what we need to do is create a closing value, so the closed price for every bar, because the relative strength index is normally calculated on closing prices. Currently there's nothing in there, so we need to create that ourselves. So we choose our market, the S&P 500 E-mini, for 5 minutes, and we click Close, and we're looking back 14 periods. This is the standard default. So now you can see we have the relative strength index on here as a new chart. But let's say we want to keep something like a moving average on the actual price chart. So let's say we want an exponential moving average, an EMA. So we type in EMA in the palette, and we simply select EMA, and we drag it on chart 1. We choose our market, we choose our 5 minutes, and it's calculated on close. Let's just move 20 to 21, a 21 period moving average. Then we click OK, and there it is. You can change the order of the graph, the axes. Let's drag this out here a bit. You can turn the watermark on and off. In order to get rid of the EMA, so let's put the EMA back on here. So we have the EMA on there. We simply right-click on the 5 minute EMA. So we'll right-click on it, and it goes away. Simple as that. You can change the thickness of the lines, everything, to make it customizable to what you need. So now we can see here, when we move one, the rest don't scroll together. We want to make sure that everything zooms and scrolls together as one. So how we do that is we go up here, right under the Charts tab, and we click Link. And that'll link everything together, and now it all moves together as one. And it'll all scroll together as well. So, very user-friendly, and it's very easy to display data. We can see here we're in a period of overbought, and looks like fairly heavy volume down here as well. And you can add many different indicators on here, as many as you'd like. There's no limit to how many you can have. So what's next is, if we go down here to collections, you can see our collection is empty. So let's add a few things in there. And in order to add things to your collection, we need to go to our palette. So let's add an open price. So we simply type open, and we drag open into our collection. Choose our market, choose our time, click OK, and now we have an open in there. We'll do the same with close. You can do it with high and low as well. To save time, I'm just going to use open and close. We can also choose the RSI. And again, the 14-period standard default. Then we can choose volume as well. So we're going to display numerically in what's called a matrix what we see on the graph here. So what we can do is right-click the new collection, view it, and it's launching the matrix right here. So we can right-click on our scroll bar here and add a synchronizer, and now it's synchronized to the charts. So not only can we graphically see what's going on, we can numerically see it as well, which is extremely useful in a lot of situations. So next, I want to show you what's called the pattern factory, which will allow us to define any pattern we want. Let's say, for example, we want to look at occurrences that the relative strength index, or RSI, is overbought, so it reaches a value of over 70. Well, that can be a pattern by itself. So what we can do is use the pattern factory. Seeing how that's already in there, we don't have to create it. We simply click the pattern factory, and it's called an RSI high pattern, so it returns the segments of overbought price bars. Okay. So now we have some parameters we have to fill in here. We have our market, our time unit, and then it'll load in some other standard default information here. So our overbought is 70. Our grace period is 2. What the grace period means is if the relative strength index falls below 70 for 2 price bars or less, that's still classified as the same overbought period. If it falls out for 3 price bars or more, then that's classified as a completely different RSI high period. And again, it's calculated on close with a standard period of 14 look back. And then we have a whole bunch of other features that are going to be included in here that you can change at your leisure. These are just all defaults. So let's just click OK. And now it's calculating the features for RSI high. And now it put that under our collections. So you can see here we have all this information about this pattern. So what we can do is right click it and view, and we're going to launch the matrix once again. And we'll take a second here. So you can see it's displaying no information. That means that there is no pattern here. It's only going to display information if a pattern exists. So let's do some scrolling here. Okay, here from 1017 at 1900 to 10/17/1930, an RSI high pattern existed. And it'll tell us, the time, the date that it occurred, the average true range, the number of price bars it lasted, a whole bunch of information. And you can add as much to this as you'd like, and you can create your own features, or what we call matrix elements. That's what the next video tutorial will show you, but that is called the formula creator, and you can create these, any wild idea that you have that you think may be a good predictor of future price movement. Feel free to make and test. That's what we want you to do. That's what it's there for. So we can see all this information here. So now let's close this. What we can do, save it in Excel format. Here you want it CSV, and then we can save it right to our desktop. And we'll save it as pattern. And then a little label here, so it saved it. And then what we can do for the time being is load that file into our third-party software, such as SPSS, to develop predictive models for that. And then once that's done, we can use that in the strategy toolbox for actually testing the model. So that's really the research toolbox in a nutshell. The next module, or not module, but the next video tutorial on the next slide, we'll go over the formula generator, which is it requires a video tutorial in itself, so don't get overwhelmed. It takes some time to get used to, but this is the research toolbox in a nutshell. Thank you. So here is the formula builder demo given by Brian here at Blackthorn, and he'll walk through exactly how the formula builder works and get you acclimated with that. So let's begin.
Hi everyone, today we're going to be going over how to use the formula tool creator. To open it up, you click on Window, and then you click on Show View, and then over here you go into Tools, and you see the formula creation tool. If you click OK, that will open up the formula creation tool. I like to drag it into the middle here so I can see what I'm working with, and resize it like this. So how this works is it's a tool that is used for aggregating and combining and generating your own matrix elements. So it needs matrix elements to start working. So the first type of formula I'm going to go over is how to do simple mathematics with two different matrix elements. So I'm going to add the close and the open together. So to start, we need to get the close, and we need to grab the close, and we need to drag it over onto this elements section here. You'll see it lights up green when you're over it, and you drop that, and you'll see close up there. And you'll do the same thing again for open. And you drop it there, and now you have close and open both here. And we want these to both be on the same market, so we're going to right click in this tree view area here. We're going to click on Add New Market. That will create a new market under the Markets tab. From this, we grab that and we drag and we drop that onto Close, and we grab that and we drop that onto Open to make them both use the same market. We can give this market a meaningful name here under the variable name, and that's what will be displayed during the generation of this. So let's just call this My Market. So then, if you want to do something with an element, you drag and you drop it into this view here, and you will see it appear. And then if we want to add that, we'll come over here and we'll click on the plus, and we'll go back over here to the open, and we will drag and drop that back into here, and you will see it says close plus open. We can adjust the settings on either of these by clicking on them, and you'll see a information about it up here in this area down here. Here we can adjust the time shift, which is how far back we want to shift the element that we'll be looking at. So if, instead of using the bar that is most current, we could use the bar that is 5 bars ago by setting that to 5. And we can use different types of range aggregation. This is how large of a range we want to use. So if we want to say add, which is what we currently have it set to, if we want to add the last 2 bars together, we would set this to 1 to say that we want to aggregate the current bar and the 1 bar behind it. We can do the same thing, same different settings for the open market. You get to this by clicking on it. So to keep this simple, let's go back to the close and set these to just 0, so that that's no time shift, no aggregation. And then come over here to name, and we'll give this a name. This is close plus open. And we'll give this a description, which is close plus open on one market. And we can click on save. Formula has been saved successfully. If it's not saved successfully, you'll see an error message here that will detail why it was not saved successfully. And you can see that if you go up here to quick access, you can type in formula and click on formula palette. And there you can see the close plus the open. So let's make a new formula that's a little bit more complicated. We can reset the formula creation tool by clicking on this button right here, which resets it back. It will give you a warning because you will lose all current things that you have loaded into the formula creation tool. So it resets it back to how it initially was at launch. So let's do a little bit of logic here. Let's say we want to use only the open. So we'll grab the open, and we want to only get a value from this open on the 10th hour of the day. So we'll need to use a date so that we can check the hours. So let's grab date and drag that over here as well. So because we want to check with the date, we'll grab date and we'll use that as the first element. And in date, you see here, day of week. You can click on this, and these are the different time units that we can check against. We want to check against the hour. So we'll leave it as hour, and we don't want to do arithmetic, we want to do logical. So by clicking on that, you'll get test values, true values, and false values. So the test value is what value do we want this to be true for. So let's say we want this to be the 10th hour. So we'll put in 10. And you'll see it's using equals. And if we were using a range here, this would come into play. But since we are not currently using a range, this doesn't really matter. So if that is true, we want to set the true value. So we come here and we expand the date, which is this element, and this is an instance of that element up there, and this is where we can set the individual values of these. So we want it to return, if it's true, the open. So let's drop open onto true value. And if not, we want it to return -1. So we click on false value, and we put -1. And that will return -1 when the hour is not 10. If it is 10, it will return the open. And then, because we want both of these to come from the same market, let's create a new market, and drop market onto open, and drop market onto date. And then we can save that as open of 10th hour. We can give that a description of returns the open value if it is the 10th hour. Otherwise, -1. -1. And we can save that. And again, it was saved successfully. Alright, and now let's say you wanted to check to see if the open was higher than the close and return a value based off that. So let's start with a new formula, and we'll grab the open, and we'll drag that in, and we will grab the close. and we will drag that in. And again, we want these to be on the same market, so let's add a new market. Drag and drop market onto both of these. And now we want to compare the open to the close. So let's drop the open on here, select the open, go down to the aggregation methods, select logical, and we want the open to be larger than the close. So we'll select larger than there. And we come into here to the test so we can see the values in here, and we'll drop close onto the test value. So now this will compare if the open is larger than the test value, which is close. And if it's true, we will have it return 1. Is the keyboard not working? The keyboard's working. Oh, there we go. 1. And if it's false, it will return 0. So we can save this as open greater than close. And we can give it a description. Returns 1 if the open is greater than the close. And we can save that. Again, successfully saved.
And now how do you apply a formula to a specific market?
To a specific market, what we'll do is to apply a formula, we'll click on this to load a market. And we'll load a market from the remote warehouse. I'll try to grab a small one. So corn end of day. Load that in, and then create a new collection. I'm just going to leave it default for new collection, and go to formula palette, and let's do the close plus the open, which was the first formula that we made. We go and we just grab and drop it from the formula palette into the collection, and you'll get this pop up here. So you'll select the market, and then it'll ask again for the market, and you can see this time it's asking for that market that you selected, which is, if you recall, the market that I called my market. And then you click OK, and now that's been created. And you can right click on that, and you can click on view.
And then the view would be the matrix element.
Yeah, you would be able to see the values of that.
Okay, so that was a brief overview of the formula builder. So getting back into the actual model steps, let's recap here. We selected our market, the S&P 500 E-mini. Then we determined the model type, mean reversion. We set our sampling frame, and as we just saw, we did our research, and we learned how to do the research in these past two tutorials. Now we're on to step 5, which is generate the hypothesis. And really it's, if we go back to the other slide, that's what the hypothesis is visually, but let's just state it out here in terms of words. So we're using a stacked combination of the RSI, Bollinger Bands, and some simple moving averages. And what we are choosing to investigate is using 5-minute transaction data using the S&P 500 E-mini continuous contract. Main reason being is it's extremely liquid, and Blackthorn hypothesizes that when stacking these multiple indicators using certain entry and exit criteria, it will be profitable for the selected market. Just a very basic hypothesis like this is what you need. Our next step is to transform the idea into pseudocode. And we can see that we've done that right here. We'll go through this step by step right now before we actually write the code in multi-charts for the algorithm. So we want a long entry. So the strategy does go both long and short. So we'll start with the long entry. So simply enough, if the RSI 14-period look-back crosses under the oversold, which in this case I changed it to 40 to get more occurrences, and the close crosses under the lower Bollinger Band, and the short simple moving average of 40 periods minus the long simple moving average of 100 periods is greater than a tick size, so a quarter of a point, and the time is greater than 7:30 in the morning and less than 2:30 in the afternoon, we're going to place a limit buy order at the next bar at the price of close of the current bar minus 3 times the tick size. So the tick size is a quarter of a point. We do that, normally the price will drop a little bit, and we want to factor that in and exploit that as much as possible. So that is our long entry. Now, in order to exit that, the typical long exit is if the close is greater than the upper Bollinger Band, so the upper 1 standard deviation Bollinger Band, or the RSI crosses over overbought at 60, we're going to sell or place a limit order to sell the next bar at close of the current bar plus 2 times the tick size, to get that extra couple dollars out of the trade. We also have the short entry, which is if the RSI crosses over the overbought, which is 60, and the close crosses over the upper 2 standard deviation Bollinger Band and the long SMA of 100 minus the short SMA of 40 is greater than a tick size, and the time is greater than 7:30 but less than 14:30. We're going to place a limit short sell order at the next bar at close minus 3 times tick size. Very similar to the long entry, except, opposite. The short exit, if the close less than the middle, just the simple moving average there, and the Bollinger Band, or the RSI crosses over the oversold, place the limit buy to cover order at the next bar at close minus 2 times the tick size. So you can tell that the long exit and the short exit may not be hit. Therefore, we need to add in extra checks to make sure that we can liquidate our positions. So some other exits we have are the trade time stop exit, which if the position is held for longer than 2.5 hours, we're going to liquidate at the next bar at the market price. Reason being is the signal from the pattern is probably not relevant anymore. Next, we have a trailing stop exit, which we have a $750 trailing stop on all positions. So if it reaches that, then we liquidate our position for safety reasons. And finally, we have an end of day exit. As we discussed earlier, we will liquidate all positions at session close or 3 o'clock in the afternoon, whichever the lesser. So we've written out our pseudocode. Now we need to write it out in multi-charts. So here you can see it's broken into the inputs. So we just define some things on what numbers to use, what values to use. We set some variables. So we have relative strength, simple moving average, Bollinger Bands, standard deviations, different things like that. Once we set our variables, we have to define our variables down here, and then we can get into our actual logic. This may look complex. That's why I wanted to show it to you and kind of make you look ahead in the future of how the strategy toolbox is going to make things, a lot easier with just drag and drop rather than writing all this logic. And this is just a short snapshot of what the code looks like. There is quite a bit more down below. I just wanted to give you a quick overview of what it looks like. So this is the visualization of the strategy that we're discussing here. We can see the executed trades based on our code. The chart shows an example of a long trade that's profitable and a short trade that's profitable. So you can see here all the criteria is met, and like I said, it normally continues to drop afterwards. So that extra 3 ticks upon entry, we could have gone even more on this one, but here, it added up, and we sold it for a profit. Here again, we sold here right at the peak, and we covered shortly thereafter for a profit. We could have held it a lot longer, but in this case, with the simple logic, that's where it got out, and it was profitable. So I want to go through the output that multi-charts gives us based upon strategy backtesting results. So once we've written all the logic, we run it, and it'll tell us, hey, this was a good strategy. These are the results for it, or hey, this needs some work. It's doing fairly poorly. So let's just go through it, and we'll explain what each one means. So it starts off giving us the net profit, which is the profitability of the strategy after commissions and slippage costs have been subtracted. We use, for every trade, we subtract $8.01 for both commission and slippage. So here, the total profitability of the model was $31,220. The majority of it came from going long. Short did contribute, but overall it's fairly promising. Next, the gross profit is simply all of the winning trades added together. Gross loss, all of the losing trades added together. And surprisingly enough, the gross profit minus the gross loss gives us our net profit. All right, the next thing I want to highlight that I think is important is the account size required. This is the amount of margin you need in your account to trade this strategy here. So we only need $5,734.98 in order to trade this, which is, a very low amount. So the return on the account based on that initial investment over the time, so since 2006, is 544%. So that's not too bad. The return on initial capital. The initial capital is assumed to be $100,000. Even though we only need $5,700 to trade it, we assume that it's $100,000 in the account, and this measures the total return based on that $100,000 over the time period of trading, and that's 31.22%. Max strategy drawdown. This is a very important piece of the puzzle here. This measures the maximum amount of money. This should actually be a percentage point here, but percentage and dollars lost while the strategy was tested. So this is the maximum amount that it lost at any given point. And it's only $5,951, or approximately 5% of our capital is lost while is a maximum drawdown. Max number of contracts held. This is a single position strategy, which means it's only going to take one position at any given time. It's only going to hold one contract. going long or one contract going short. There's no algorithm that says, hey, this is a likely signal to make money, buy 2 contracts. It's only going to take one, no matter if the signal is very strong or very weak. Commission and slippage. Commission is what's charged by the broker for actually going through with the transaction, which is approximately $2.01. Slippage is the estimated number that is the difference between what the expected price of the trade is and the price the trade actually executes. And here we say approximately $6 per trade, totaling $8.01 per trade. We're subtracting from the profit. In this case, the strategy allocated over $21,000 to commission and slippage. So the buy and hold return for this period, if we just bought the S&P 500 E-mini the beginning of 2006 and held it until the strategy ended, we would have lost almost $10,000 compared to gaining over $31,000. So that shows some merit there. This is another table that Multicharts will give you. It's the trade analysis, and you can see here the total number of trades executed during this time period is 1,333. There are, about 100 more long trades than there are short, which that's fine. The number of winning trades here. Out of the total number of trades, we have 855 that are winning. So that's fairly promising. And only 478 that are losing. The percentage profitable, which is simply the number of winning trades over the number of losing trades, is 64%, which is, a fantastic percentage. You want something high like that. The win-loss ratio is the average winning trade divided by the average losing trade. Here you can see we're only at 0.7. You want to get that over 1, but seeing how our percentage profitable is so high, that's how we make money. We're winning a lot more, but we're not winning as much as our losses. The average number of bars. This section here measures the average number of price bars for different areas. If you're interested, take a look at that. It's not overly important for the time being. So the next chart here shows our performance ratios, and we want to look at the Sharpe ratio here, which is a measure to calculate the risk-adjusted performance. It's calculated by subtracting our risk-free rate from the portfolio rate of return, and here the risk-free rate I think they use is 2%, and then they divide that by the portfolio return standard deviation. Next is the Sortino ratio, which is a measure to calculate and differentiate between upwards and downwards volatility, which allows the calculation to provide us with a risk-adjusted measure of a security or fund's performance without penalizing it for great upward volatility. So we simply minus the risk-free rate from the strategy return, and then we divide it by the standard deviation of only the negative trades. That's the difference. So next here, this is our equity curve over time. We can see here beginning in 2006, going all the way until September of 2013. So we initially made some money here. We saw some drawdown, dip down in the red, and then really gained momentum here up until 2008. Here is the big market crash, which is where we saw our maximum drawdown, and we saw fairly steady growth thereafter. So this looks very promising. These charts here show us the equity curve for short trades and the equity curve for long trades. Short trades, they've been fairly even the past number of years. Short trades you'd think would make money in a market crash, but, you know, they didn't do overly well. They made money leading up to the market crash, so there were some good signals there. You know, long trades, we didn't get killed too much during the market crash, and we saw steady gains. Obviously, short and long both contribute to the net profit, so it's not something that we need to trim either one of them to make to get rid of losses. They both contribute, so that's good. You know, once we have all that information, we can continue towards the strategy write-up. And what this consists of is, we call it the football, and we pass it back and forth between Blackthorn Analytics and Blackthorn Capital. And it provides them with a cover page, along with a short strategy snapshot explaining what it is on the front page. It can be, you know, a little paragraph, and then a picture of the methods used, just so they understand it visually. Then we'll go into, you know, what we tried to accomplish with this through the hypothesis. And again, we tell them the sampling frame, why we chose it, certain times of the day it trades, and make sure you give an explanation. And then just some background information. So maybe it's, you know, what's the symbol of the market, what's the type of strategy it is, just basic things like that, so they understand, hey, this is what you're doing, we don't want to change it because this is what you're trying to accomplish. Then we write an abstract. This can be a couple pages long, just going through and verbally describing the steps that you're trying to accomplish and some information describing your logic, things like that, just so it doesn't have to be in great detail, but enough detail where they understand and they're not going to have many questions. Then after the abstract, include your trading logic. So include your pseudocode pretty much. That's another reason why you write pseudocode, is to include it in your strategy write-up. And then towards the end of your write-up, you want to throw in your backtesting results. So pretty much everything that we just went over in the previous slides, you want to include all that and make sure that you know how to interpret that. And finally, recommendations. You want to be able to recommend improvements for your strategy, as well as Blackthorn Capital will also send it back with recommendations on what they feel needs to be changed or added to your strategy to make it more profitable. And then finally end it with key functions. So if you use formulas or equations in your model, make sure that those are all defined in the key functions section of your write-up. That way there's no misunderstanding when testing on the side of Blackthorn Capital what measures you used or how you calculated certain things. So examples of recommendations. For my model here, I would say we need to implement statistical methods. We need to say, or we need to calculate a logistical regression model, which will calculate the probability that the signal will cover the transaction and slippage costs. And it'll provide us with a 0 or 1. And only if it's a 1 do we enter the market. This will eliminate the bad trades. Next, we can implement the multivariate regression model. We can use predictor variables, like we discussed, to set both profit and stop levels. Instead of just setting it at technical indicator lines, we can implement this to have more accurate and take advantage of those trades that could run further than we expect. And finally, we can have a Cox proportional hazards model, which predicts how long until the signal is obsolete. How many price bars do we have to wait until we just need to liquidate our position. Another thing that's currently being worked on is OLAP analysis, which creates multidimensional analytical queries. We can see here at the bottom of the page, let's go back. We have regions, sales information, and time, and we can select out certain blocks here and do analysis on that. In our case, it could be hour of the day, day of the week, other certain factors that we find interesting. We can pull that out, analyze it, and say, hey, when this happens, we need to bet double because we always win. And things like that that allow us to become more profitable and manage risk. Moving forward, eventually we want to have all the math done inside the research toolbox. We're not going to use SPSS. We're not going to use MATLAB. Everything will be done in the research toolbox. And we're working towards that at the current time. And as you can tell, multi-chart and Visual Basic can get semi-complex when coding, especially when you don't have coding experience. I didn't have any coding experience, and it was rough for me to start with that right out of the blue. So simplifying the strategy creation, there's going to be no code in the strategy toolbox. It's simply you're dragging and dropping things in state machines, and it's doing your testing. Very easy to use and very intuitive. So that's where we're headed. So thank you very much for taking the time, and enjoy.